This
So
meeting
I
is
see
being
everyone's kind of
archived.
funneling in here, so maybe I'll get started. Hi, good morning, everyone. This is Joe Cardoso from the U.S. Hardware and Networking team at JP Morgan. And we have Kathy Ta, Head of Investor Relations from Lumentum, with us today as a follow-up discussion to the fiscal 4Q earnings call from last week. Maybe before we get started, just as a kind of reminder here, I just want to flag to everyone on the call that this event is really for you to get your post-print questions asked. And so we encourage you to either raise your hand on Zoom and we can call on you and unmute you here to ask your questions live, or alternatively, you can send your questions into me via either the email, or alternatively, you can ping me on Bloomberg or whatever methodology you guys prefer. If you guys look at the bottom of my video screen, you can see my email right there for easy access. So please feel free. I encourage you, send your questions in and we can get them asked and answered here from Kathy. So with that said, Kathy, thank you for the time. I know it's late your time as well, so I appreciate you carving this out for everyone here.
Yeah, of course, Joe, and thanks for your support on this call and in general with your research, and thanks to everyone for joining us in the call today.
No, that's great. Okay, so like maybe let me kick this off with the first question, and then we can take some questions from investors. But Kathy, I think every quarter, there's something moving, changing underneath the Lumentum story, some new opportunity, maybe some shifts in opportunity, but a lot of things are evolving since maybe you guys gave, the targets or forecasts back at OFC. So maybe we can just start there. From your vantage, what has been the most incremental changes since OFC and kind of the outlook that you provided at that time, and particularly what you had outlined?
Yeah, that's a great place to start. So I think many folks on this call were able to participate in our last Investor Day or investor briefing, which was held in the March timeframe of this year. And it's only been, I guess, 6 months since that time frame, but it feels like a lifetime ago because some things have changed, and it seems that most things have changed for the better. On the CPO front, during the summertime, I think there were a lot of fears that CPO was pushing out. But in fact, that is not what we see. And if anything, we are seeing increased demand from NVIDIA, our CPO customer. That increased demand factors into what they want us to ship for scale out CPO, but it also sort of bleeds into what they expect us to be starting to ship in late calendar 27 for scale up CPO. Another thing that has gone to our favor is that, and we announced this on our last earnings call, we won our first external light source package business, and that was from NVIDIA. And that will start to ship again in the second half of calendar 27. So it kind of feeds into the same time frame as the scale up CPO, which is expected to get started around then, at least in terms of our shipments into the customer. And then they will ship product at the beginning of calendar 28. NPO has definitely shifted earlier and bigger than what we had expected at the OFC timeframe. So back at OFC timeframe, we had sort of combined together CPO and NPO as one big market opportunity. Now we understand that those are two somewhat different market opportunities, with the world outside of NVIDIA basically pursuing an NPO strategy. And that NPO strategy looks like it's going to start to take off for us again. Shipments at the very end of calendar 27 for deployment in early calendar 28. Now, we haven't been able to announce any distinct wins there yet, but I think that is on the come in the next handful of months. Then I'll move to OCS. I think we are doing somewhat better than what we had projected at our OFC analyst briefing timeframe. What has happened in the last few months has been a better grip on our supply chain, We have ramped up our manufacturing capacity to enable our shipments according to the demand from the customer. Demand from the customer is very strong. So I'd say that is up a bit since the OFC timeframe. Scale across is definitely something that we undercalled at OFC, dramatically undercalled. In fact, we didn't talk about it enough. Now that I look back, I think that was a little bit of a miss on our part in terms of our messaging. In the months since the March timeframe, we have moved up in our scale across view. We now know that there is a lot of demand for pump lasers from us. We have signed 7 different customers into long-term agreements with us. Those long-term agreements are 3 to 5 years in duration, depending on the customer. And that has definitely been very much more business in pump lasers and to some degree narrow linewidth lasers than we had expected at OFC timeframe. And then finally, I'll just end it with 1.6T transceivers. We are seeing the benefit of 1.6T transceivers moving into our business profile perhaps earlier than we might have expected during our analyst briefing timing. Such that starting with our September quarter that we're in right now, and then also December quarter, we're going to be shipping a whole lot of 1.6T transceivers. I think we are a little bit skewed in our view of the industry because we're exposed to some very specific customers in our transceiver business. So I think we may be seeing more of the leading edge of what is required in transceivers than other people. So I would not conclude that 800G is done with its growth for the rest of the industry, but nevertheless, I think we are seeing perhaps our fair share of the market for 1.6T, and it's coming in the second half of this year. And then finally, I think we're above model on our financial targets. We have been at the high end of the margin or the revenue targets that we've set out for ourselves, and we've been above the high end of the profitability ranges that we had communicated at those revenue levels. So all things are going well at Lumentum. And I'll end it there because I've kind of rattled on for a while. So I'll let you ask the next question, Joe.
No, Kathy, that was perfect. Very, very thorough. Maybe instead of me asking, we'll see what Daniel, you can unmute yourself and ask your question.
Yeah, thanks, Joe. Hey, Kathy. I've just got 2 questions. So first one, obviously, the MPO opportunity is really exciting. Maybe like just to be super clear, you've obviously given us some good color on the CP opportunity with, I think it's like the 50 million in fiscal Q2 and then execute on the multi-$100 million order in the second half. How should we think about MPO in terms of like I know you're talking about shipments towards the end of 27, but should we expect anything in fiscal 27? And then maybe just sort of like tie that into the magnitude of the TAM relative to CPO. Like obviously, like CPO is one customer versus many customers in MPO, but that customer is very big. So maybe just sort of help us size how you're seeing those 2 market opportunities, because as you said, they are becoming a bit more discrete.
Yeah, good question. So NPO, ton of activity. I don't think that there is going to be much meaningful revenue for us in our fiscal 27.
Yep.
I think we will manage to announce, depending on the timing of our announcement of our first win here. I would put that time frame of like our first laser chip shipments would be maybe at the very end of 27, calendar 27. And then hopefully we'll be able to win additional business beyond laser chips, still TBD on that front. In terms of sizing the opportunity, I would if you would allow me to think about like the 2028 timeframe, calendar 28, our view of the world has evolved to now understanding that, okay, perhaps the NVIDIA CPO world is about half of the market opportunity. And when I say market opportunity, it's a self-serving Lumentum opportunity. So half of our opportunity is probably going to be from NVIDIA. And the other half of our world will likely come from the NPO side. Within the NPO half of the world, it looks like there's another half and half that we can talk about. So half of the NPO world is looking like they want to deploy an external light source type of form factor with an ultra high power laser chip. That laser chip could be similar to the platform that we have for NVIDIA, or it could have a variant associated with it. And in the past, we've discussed the possibility of having a WDM, like a wavelength, several different wavelengths attached to that laser opportunity. We would be vying for also serving the ELS package along with that laser opportunity. So that's what we're really targeting. We will see how the decisions go, but that is sort of half of the NPO opportunity. And there's at least two major players that are looking into that style of NPO. And then the other style of NPO looks like it's inside the box, integrated with an optical engine, which we are also interested in serving, the optical engine piece. But that inside the box solution would use a lower power laser because it would be closer to the compute, and therefore it would use perhaps a 120 or a 150 milliwatt medium power laser. I think we'll still call it a high power laser, just not an ultra high power laser.
Yeah.
But there we're interested in the laser opportunity, and as I mentioned just now, the optical engine opportunity, we'd be interested in that as well.
And just a really quick follow-up on that, like, is that 25-25 split just for like illustrative purposes? Like, I'd assume that first bucket would be sort of higher content to Lumentum. So is that sort of how we should think about it? Like, is it more like, I'm not trying to pin you on a number, but like just for a rough thinking, is it more like 30-35 of the 50?
Yeah, good question. I think in terms of the market opportunity or what we'd have access to potentially serve, it would be roughly 50-50 because the optical engine content would bring up the ASP of the integrated unit inside the box. But to your point that you just raised, the mid-power laser would probably have a lower ASP than the ultra-high power laser.
Perfect. And then just last question, just on the gross margins. Like, it sounds like you're obviously talking about this ELS module order that you got, which is great. Just thinking, and obviously that's like a very big dollar content. I mean, sort of we hear about, I mean, tell us if I'm majorly off the mark here, but like maybe close to like $10,000 worth of sort of like overall module content. Obviously like a lower margin. So maybe just help me sort of think about, yeah, how obviously relative to a laser chip, which is sort of more in like the, call it tens of dollars to my understanding. Tell me if I'm wrong there. Secondly, how should we think about gross margins? Obviously, that's been a really key lever of your earnings growth over the last sort of couple of quarters. And obviously, yeah, as it gets higher, it obviously gets harder to sort of show the same expansion. But yeah, should we be a bit more reserved on how we expect gross margins to progress going forward, just because of that dynamic?
Great question. As you already said, and you've almost answered your own question within your question.
Yeah.
So our laser chip margins are amongst the highest margin products in the company. The good news is that for an external light source package, roughly half of the content is comprised of our laser chips. We don't have the DSP any longer, and therefore our landed ASP for the ELS with our lasers in it would still be margin accretive, but it may be just above our corporate average gross margin and operating margin.
Thank you so much.
Yeah, thanks.
We do have Brian with his hand raised, but just given that there's a follow-up here via text that is related to Daniel's line of questioning, maybe I'll just jump ahead of that and ask this so that we can stay topical. It's a two-part question, so I'll read the first part first. What is the trade-off between using the internal versus external laser for MPO from a customer perspective?
I think it has to do with different elements of the supply chain that are not related to Lumentum. So
Okay.
the internal solution would make use of different actors in the supply chain, from printed circuit board people and sort of the integrators on the transceiver side. So I would think of Eoptolink or InnoLight could participate in that sort of opportunity, versus so the sort of integration that would have to be more semiconductor-like in nature, that would enable an external light source like module. So it kind of puts pressure on different parts of the supply chain for the given customers. So it depends on what their strategy is and how they're accessing the rest of their supply chain. I think ultimately, we believe that all technical roads eventually lead to CPO as the most power efficient solution, and arguably the more reliable solution, because the more things are so-called fastened down, like if you're doing the 3D package of your optical engine with your compute, then all the yield issues have been sorted out at that point, and then it gets shipped out to the field. Everything's fastened down very well, and it doesn't have yield issues thereafter. I think that is the ultimate end game of most technology roadmaps. But the reality is that people don't have access to this very complex 3D packaging capability, mostly through TSMC.
No, makes sense. And then the quick follow-up here is more on the optical engine opportunity that you highlighted in terms of an area that you guys would like to participate. The question reads, can she elaborate on how they're going to be involved in optical engines? And then will that be an indium phosphide process?
So we have been involved in design of silicon photonics, which then we would have a foundry partner build for us. I would imagine that that would be a scenario that we would undertake. So we don't have a silicon-based process internally in terms of our manufacturing.
Nope, got it. Okay, Brian, sorry for making you wait. Please unmute yourself and ask your question.
Yeah, thank you. Thank you for taking my question. Can you hear me?
Yes, I can hear you.
Yeah, thank you. And one of my questions is about your capacity. You got the EML capacity will increase 50% this year, right? So how should we think about next year, and also maybe your CW laser capacity this year? Yeah, thank you.
Yeah, so question about our EML capacity and what we expect to expand into calendar 27. We haven't quite gotten there yet, so I'm reluctant to do that now with this group. We haven't messaged that officially. What we have said is that we are still committed and on track to increase our units of EMLs by 50% compared to the exit rate of last year, and the exit rate of this year. We expect this year to be 50% more units of EMLs. And we have also said that we expect the proportion of 200G EMLs will grow within the mix to basically 50% of the revenues will come from 200G EMLs. which is the same as saying about 25% of the EML units will be 200G lane speed. And we're sticking to that, and we're on track to that. What has evolved since that time frame is that we have decided to somewhat opportunistically also provide a 200G lane speed CW laser to several different hyperscaler customers. And we're doing so, it's in a margin accretive business. It's actually sowing seeds of goodwill for the future with a couple of hyperscalers, because there's an acute shortage of 200G lane speed CW lasers in the market right now. And of course, we're in this for the long game. So we want to make sure that we can serve our customers and get the benefit of their partnership later on when they're making decisions about other designs. So that's sort of the mindset there. It's a relatively modest amount of capacity that we're allocating for these CW lasers. This last quarter, it was almost 10% of the revenue capacity. And I expect that this 10% will grow to no more than 20% of the revenue capacity in future quarters. Because these are very specific programs that we're serving. And our primary focus will remain EMLs.
Yeah, okay, thank you. And second question is about your pricing strategy. I know this quarter you kind of raised the price. May I know what kind of the products you are raised the price?
Yeah, so we've undertaken some targeted pricing increases on EMLs, and those pricing increases took effect in the March quarter of this year. And they've stayed at the same price since then. We have in the past raised prices a bit in narrow linewidth lasers for data center interconnect products. We've also raised prices in pump lasers, and that is probably the most recent pricing increase in LTA signing that we have done. And that the purpose of the price increase was to help us with our CapEx spend that we will need to spend in order to expand our capacity for pump lasers. And this is in service to the scale across opportunity. In the June quarter that we just finished, we saw a partial quarter of price increases for pump lasers. And in the September quarter, we'll benefit from a full quarter worth of the effective increased price. So part of our sequential ramp in pump lasers will be a pricing increase. And then from that thereafter, it will be just the volume increase because we have invested in the capacity and we're going to be able to produce more pump lasers.
Okay, got it. And so you mentioned you have already signed many LTA with your customer. May I know for this LTA, do still have any opportunity to raise the price for LTA, or maybe just the price is already fixed?
Yeah, it's kind of a complicated answer that I'm about to give you. So as with most things, it depends, but which is not really a satisfying answer to your question. So I will try to help further. So we can reserve the right to renegotiate for a higher price point. We have not done so in the LTAs that we've already signed for EMLs and for pump lasers as examples. We can also fulfill the minimum requirement for the shipments that we need to make according to the LTA. And then anything above that, we are allowed to charge an expedite fee. So that has been taking place for EMLs because we have done better than what we had been obligated to deliver. And so we've been able to charge expedite fees there. And this is probably also true on pump lasers. So if we're able to produce more than the minimum contractual agreement, then we can probably charge for the an expedite fee above them.
Okay, thank you. It's very clear. Thank you. I will back to the queue. Thank you.
Yeah, thanks, Brian.
Thanks, Brian. We do have another question coming through. It might be multi-part, but basically the question is trying to get a sense of how big the pump laser revenue opportunity is. Just given that you've also talked about 4xing it over the next couple of quarters, if I remember correctly.
Right.
Just trying to see if there's any other elements in the question.
Yeah.
Yeah, that's
So maybe I
basically
can-
it. Just trying to size it. Yeah. Go ahead, Kathy.
Okay, that's fair. Yeah, so we first started talking about the quadrupling of revenue in our March earnings call. And at that time, the revenue level was 45 million. So that's the baseline. And you can 4x off of the 45. I think we have a fair chance of doing a bit better than that, but that is basically what we meant, that we would 4x off of the 45 as of the March quarter. And we would, in the time frame of the next 4 or 5 quarters, would be the time frame where we would see that benefit. So in the neighborhood of 200 million a quarter.
Got it. No, that's super helpful. Maybe I'm trying to think of what direction to go because everyone asked different questions here. Maybe I'll take it back and go back to one of your original questions or one of the original comments that you talked about in terms of the first ELS order. And one of the questions we got a lot post the earnings print was essentially how should we think about the sizing and materiality of that business? I mean, or in terms of the order that you won. And then I guess maybe the other question there is, you know, obviously NVIDIA is ramping their CPO for scale out today. Is the win being back half weighted in 2027, indicating that's more for their scale up opportunity versus scale out? So I guess two-parter is one, is it more scale up aligned in terms of the opportunity that you won? And then how should we think about the sizing of that opportunity in terms of what you had win?
Yeah. So maybe I'll answer that in a couple of different ways. So one is on a per unit basis, just the ASP of a ELS FP is about 2x the content of the laser chips alone. You can think in the ballpark of, I don't know, $450 per ELS FP is sort of where we're think what you can think about in terms of a price point. And then in terms of our share of opportunity, this is a guess on our part, but we believe that we have line of sight for about 15 to 20% of the ELS FP business for scale up. We received the first purchase order only, so it doesn't amount to 20% just yet, but that is our estimate based on other communications with the customer. And then, as you said, Joe, it gets started in the second half of calendar 27.
Understood. No, makes sense. No, super helpful. Maybe the other one that I wanted to touch on was the CW laser opportunity, and maybe I'm paraphrasing what you said here, but it sounds like you guys see it kind of capping out at the 20% percentage of datacom revenue X anything related to CPO or NPO. I guess what's driving your conviction around it? I know you talked about it being aligned to specific programs, but maybe if I were to play, you know, devil's advocate here, in the sense of you guys also had talked about that or similar context around transceivers, you know, in terms of potentially seeing a cap, but then obviously trying to prolong the customer relationships and stuff like that. And it seems like this is a similar dynamic. I guess maybe just help us think through that dynamic.
Yeah, it's a really good point, Joe. We might find ourselves victims of our own success here, and helping out customers with what they want. Yeah, all I can say is that the programs that we have won, that we are attached to in our forecast, sort of net out to a max of like 20% of the revenue coming out of datacom laser chips. I just want to clarify that. X ultra high power lasers. So basically, the combination of EMLs and CW lasers for regular Ethernet transceivers is what we're talking about. And that is, from what we can see now, just going to be maxing out at like 20% of the revenue. I would not be shocked if, a year from now we come back and say, oops, we did it again. And now we're, stuck with some more CW laser business. And it's not bad business to have. It's margin accretive. Our team in Japan has been doing really well and adding additional capacity and just squeezing out the most that they can from our 2 wafer fabs there. So it wouldn't be a terrible thing to have ourselves a foot in the water on CW lasers.
And just in terms of margin accretion, is there any range that you can kind of give us in terms of thinking about the opportunity in terms of where the margins end up tracking to?
Yeah, I mean, we shrunk the die of this 200G CW laser, and we are able to still, I believe, get some amount of premium pricing because of the scarcity of supply and our brand promise of tighter specs, better outcomes in your transceiver build. That all nets out to be above our 50-40 type of company margins that we're now reaching. I guess I'll
Got it.
just end the sentence there.
No, fair enough. We'll take some additional questions now. Chiao Mao. Sorry, Daniel, I know you. Let me just take one of the new questions. I'll get to you. Please go ahead.
It's all good. Thank you. We actually work in the same company, so it's just as good. Hi, Kathy. Good seeing you. Maybe just quickly double back on OCS. Good to see triple-digit million quarter coming. But I think you make the comment that you're on track, but not ahead of that 400 million target. But since then, we definitely see more interest on OCS beyond just the one initial customer. So maybe just talk through the tracking. Is 400 million sort of where you will plateau in the near term, just giving capacity, or what is the real sort of addressable market looking?
Yeah, I think those are 2 different dynamics. I think the demand is definitely there and probably has increased since our analyst briefing and since we first messaged the 400 million in the second half of this calendar year. I think the reality of our ability to supply is the question mark. I think we're going to get pretty close to the 400. It's just a matter of our ability to produce, and nothing different than that. I think it does set us up very well for calendar 27. The only thing that we've said publicly about our OCS revenue profile is that it would be above $1 billion, which doesn't take a lot of higher math to get to that estimate. I think we could do quite a bit better than $1 billion, but we haven't officially said any sizing for calendar 27. But to your point that you raised, I think the demand is definitely there, especially from what is now our largest OCS customer. Their demand keeps increasing. So this is a good thing. In terms of other players getting involved with OCS, I agree with that comment as well. I think that time frame might be a little bit later. Maybe we will see some early phase of deployments at the very end of calendar 27, or maybe it's more of a
깜짝 놀랐네.
calendar 28 story. And it has to do with
근데
sort
그
of,
위에다 얘기했거든. 우리 이제 주문 안 받을 거라고. 근데 보니 서로 대화가 안 됐나 봐.
sorry about that. So I think what we are seeing and what we've hinted at least in our previous discussions, was sort of this in-tray, smaller form factor OCS that could make use of dynamic partitioning of a compute cluster or a redundant network in the case of underperforming XPUs. We still see, we do see a lot of interest in that, and for more than one customer. So it is very encouraging for the future, and something that we're definitely working on and would like to win.
Great. And then maybe just two really quick follow-ups on that. I guess the one is when you talk about the revenue profile of $1 billion, I think Michael also talked on the call that, you expect to be the majority provider of OCS for your first customer, sort of larger than their internal production. So if I link those two together, is basically saying once you pass the half point of the existing customer, is that basically the $1 billion mark? And I guess sort of a bit of a follow-up to that is once you get to that scale, will then the OCS margin, like what kind of margin should we be thinking about?
Yeah, I mean, I don't know that we have super clear insight in terms of what that customer is supplying to themselves internally. We do get the sense that certain SKUs in particular, there's a couple of different flavors of SKUs that we're shipping, and at least one of them we know we have 100% share of, and it's the latest one. So I think that's where Michael's comments kind of come from, is that it looks like it is tipping in our direction as they progress on their technology roadmap and their new topologies. So that's all good news. In terms of the margins, we expect to make increasing use of contract manufacturers as we get into calendar 27, because we are so constrained in manufacturing floor space and just capacity to handle more OCS business, such that internally, I think we will retain about $1 billion run rate of business. But then for anything in excess of that, we will look to get some help from contract manufacturers. And that is, the training is underway. Our people are on site at contract manufacturers. Our early indication is that it should be more or less transparent to margins. So we are not the low-cost leaders in our own manufacturing, is what that means, that we're able to get a reasonable pricing with our contract manufacturer partners.
Gotcha. And then just to double check, the OCS margin is accretive to corporate average as we speak?
Yes, it is above 50 gross margin, and the operating margin is above 40.
Gotcha. Even at the current scale.
Mhm.
Great. Thank you so much. That was super helpful. Thanks, Kathy.
Yeah, thank you.
Daniel, why don't you go ahead?
Yeah, awesome. Sort of just pulling the thread a little bit on that capacity tightness that you guys are saying. Obviously, like you talked about, I think it was at OFC when you announced that Greensboro fab, obviously, and then you talked about all these growth drivers that obviously were, I assume, meant to fill up that Greensboro fab, and then you sort of started the call today by talking about all these other things that are coming along. So basically, what I want to ask is like you sort of explained on the OCS side there, like the contract manufacturers, which makes sense, but for everything else, like, is the Greensboro fab enough for you to basically capture all these opportunities that you're talking about? And what should we expect in terms of, I don't know, would you do greenfield? Would you sort of look to do more fab conversions? And when would you sort of be running out, like into the, like, you've obviously got that $8 billion target out there, or like if you annualize the $2 billion quarter, it seems like you're going to reach that pretty quickly. So, yeah,
Yeah.
just talk to us about how you're thinking about capacity as all these new opportunities sort of really hit the sweet spot.
Great question. I think at the moment, Greensboro is half spoken for
Yep.
in the form of NVIDIA. We could see Greensboro completely fill up with NVIDIA, or we could see an NPO customer or two help us to fill up Greensboro. I think we will, I will have to wait with what we do next because we haven't messaged that specifically. But I don't think it would be the greenfield option because it would just take far too long to break ground, build a new facility, and occupy. So we would either do another brownfield, much like Greensboro,
Yep.
or and there are contenders of fabs out there that we might be interested in. The other option in this maybe is somewhat equally likely or may happen in tandem is we continue to expand on our existing footprint. There is plenty of room to expand in our UK facility, and that has some advantages in terms of being able to process the first layers of indium phosphide substrates that could come from China. And then also we have, I mean, if you've seen like drone shots of the Greensboro fab, there's plenty of land around there. We could expand that Greensboro fab. So I would put that as somewhat likely as well. We are not done building out our capacity in our second fab in Japan. So that's sort of our answer for all non-ultra high power lasers is that
Yep.
we have still room to run there as well.
Okay. So, and I mean, maybe I'm getting too deep. Maybe I'm reading too much in your response here, but basically, like, it sounds like the OCS, you have the contract manufacturers for the non-ultra high power stuff. You have Japan, and then basically, like, should we think about this 5 billion revenue capacity at Greensboro as being like a CPO/MPO hub? Like you're saying, it's half of it's for NVIDIA CPO, and then the other half could be more NVIDIA, or it could be like basically, would you expect all the vast majority of the output of the Greensboro fab to be either CPO or MPO?
I do expect that Greensboro will be either CPO or NPO. And to be clear, it's a wafer fab. So it would be laser chips in every instance that would come out of Greensboro and not any other process step.
Okay. Okay, that's really helpful. And okay, and then just like, so if we're thinking about other capacity being for the rest of the business, when would you need to, if we're just looking out like, I don't know, Greensboro's coming online in FY28, when would you need the next capacity to come online in order to not sort of handicap yourself in terms of growth?
Yeah, I think we're running a lot of parallel expansion plans. So it's sort of a moving target,
Yep.
depending on when we're able to announce the next wins. But yeah, I think we would have to make that decision once we actually fill up Greensboro with more business, either through the CPO route or the NPO route. But in the meantime, I think our intermediate plan is the birthplace of ultra high power lasers is ironically here in California,
Yep.
which is a very space constrained fab. We are underway now on our qualification in our UK fab to make ultra high power lasers to see us through basically calendar 27. I think there's room to run there. There's plenty of land, and we have expanded that clean room already. So I think there's more capacity to tap into there. So that could be part of our strategy once we so-called fill up Greensboro.
Okay, my last question, I just can't see out the hand. So one more, just to like sort of tie this all together. So you're like assuming the capacity is entirely spoken for, we should expect the 2027 ultra high power laser revenue plus 5 billion in terms of what you will be able to execute on in, let's call it FY29. So yes, assume the 5 billion revenue capacity gets filled for MPO plus CPO plus whatever you're able to deliver in 27 through California in the UK. That's sort of how we should think about it.
Exactly.
Perfect.
That's right.
Thank you so much. That's really helpful. Thanks.
Yeah.
Thanks, Daniel, for the question. Kathy, if I can squeeze two more in.
Yeah, of
Hopefully
course.
they're on the shorter side. So basically the next question is more around just trying to get a sense of where transceiver margins are today and how you're thinking about that with the 1.6T ramp, just given the pricing element associated with that. And are you guys feeling in terms of the trajectory around the transceiver margins better than probably, I guess, maybe a couple quarters ago?
Yeah. In a nutshell, we are today with mostly 800G transceiver builds as of June quarter that we just finished. Those margins are about 20% gross margin. As we look forward to more 1.6T volume, we can approach 30%. And if everything was 1.6T, maybe we can asymptotically approach 35% gross margin, and we probably max out around there, at least for what we know today. And that's good business because then there's a lot of cash that's generated, a lot of partnerships that are developed with customers, et cetera. And as long as we can manage to grow the rest of the business outside of transceivers at roughly the same rate, then we'll keep the gross margins moving in the right direction.
Got it. And so maybe just quick clarification there, just in terms of the 1.6T, in terms of, I guess, 100% shipments gets you to 35%. Does that also assume 100% vertical integration as well, or?
No, not necessarily. I mean,
Okay.
our plans today, thank you for clarifying that, by the way, Joe. So our plans today are only about 20% of our 1.6T fleet will use our laser. Again, this is a little bit of a sacrifice on our part because we would rather make the email lasers and ship them externally. But we also participated in the crisis of not having enough 200G lane speed CW lasers, so we supplied ourselves for one program. I don't think that is our game plan to keep increasing our internal sourcing, but we'll see how the industry progresses. It's a nice fallback plan if need be.
Got it. Depends how many fabs you guys end up buying. So the last question here that I'll ask is just maybe it's just a broad question, but it's essentially how are you thinking about areas of bottlenecks across the supply chain, and maybe if you can kind of walk us through where you think, the tighter, I guess, rank order it kind of.
Yeah, I mean, I think our primary limitation is in our transceiver business. If you think about the transceiver builds, you're basically taking a whole bill of materials, which is mostly not under our control, and you're assembling it together into something for the customer. So that is not surprising, is where we see the most supply chain limitations and risks. And it is across the board in terms of the bill of materials. Recently, it's been DSPs have been tight. We've already gone through a crisis on CW lasers. Almost you name it, we've had a shortage of one component or another. We have had in our recent past, shortages in our OCS builds in terms of some of our bill of materials. I think we're healthier now. So we have really shored up our supply chain there. So I think that will be less of a risk going forward, but still something to watch, I suppose. And then then I would kind of point to, I guess, substrates for indium phosphide laser chips might become a shortage when we get into the proper scale up timeframe. So think in terms of calendar 28, which is exactly why we signed up with yet another supply agreement with AXT. And some of you may have seen the 8K that was issued just a couple weeks ago. So the mindset there is we need to press on every button to get our security of supply of indium phosphide substrates to enable us to be ready for scale up timeframe.
No, got it. No, I think that's all the questions, and obviously we kind of went a little bit over time. So Kathy, thank you so much for spending the time. Always super helpful to get your insights, and thank you for all the investors who joined our call tonight. I really appreciate it.
Yeah, thank you so much, everyone, and thanks, Joe. Thanks for hosting us. Appreciate it.
Of course. All right.